Hello and welcome to Seeking Alpha Interviews. I'm Jane King at the NASDAQ market site in Times Square. And with me today, Brad Thomas, the editor of the Forbes Real Estate Investor, also a Seeking Alpha contributor. Welcome.
It's great to be here. Thank you so much.
So let's talk about real estate. I know that is your area. Let's start with just the overall. How do you see the overall real estate economy right now? And you specialize in commercial.
Sure.
So let's focus on that.
Sure. Well, I think that, real estate market's doing very well, especially in the U.S. So I focus just on U.S. Real estate securities, but overall the market is performing very well. When you look at real estate versus stocks, I want to make sure we distinguish between the two, because real estate has a longer life cycle than the stock market does.
Sure.
So as an analyst, one thing I look at is the overall life cycle of real estate today. Now that we have a new president who knows a little bit about real estate,
Sure.
I think we're seeing a lot of positive signs as it relates to that life cycle, and perhaps even we're going to see, I like to use the analogy of the baseball, we're probably going to move to the ninth inning, maybe a couple more innings out now. So I definitely see a continued bull market moving forward in real estate. So we're very bullish on real estate securities.
That's really interesting because we've come a long way already since the downturn 2008, 2009, but you think this even goes further, and a lot of that's probably policy driven.
Sure. Well, and remember, 2009, the recession officially ended in 2009, but it took a number of years for that to thaw out. Really, that recovery was a lot longer than people really thought it was going to be. So now, you're right, we're seeing a lot of storefronts being opened up. Vacancy has really come down. What's interesting, though, is construction levels. Again, looking at supply and demand overall in the U.S., we're still below levels, supply levels that we had even before the recession. So we've seen that balance. A lot of the banks have been a little leery of lending money, so we're starting to finally see that opened up. So I think, again, everything's in balance right now across the, in general. There are some sectors, for example, in New York City here, we're seeing the apartment sector is getting a little built out. So we're, in different sectors that we cover, but overall, I think the market is well positioned.
Now, we are seeing Federal Reserve Chairwoman Janet Yellen talking about interest rate hikes, kind of teeing those up for this year. Does that play into your scenario? Do you think that will have any kind of negative impact on real estate?
Sure. That perhaps, Jane, is probably one of the biggest misconceptions that I deal with on a daily basis, is the concept that rates are going to crush REITs, or real estate investment trusts. That's absolutely wrong. It's false. And the reason is, look, rates are positive. The Fed has one job, and that is to monitor interest rate policy. And as rates continue to rise, and we saw this week, we're going to see probably 3 rate increases this year. So that's what it appears. And so all that means is that when rates rise, that means that you're going to see rents rise across the board. And when rents rise, you're going to see earnings rise for these REITs. And of course, the most important thing that investors like to hear is that dividend increases. So we're going to continue to see those robust dividend increases that we've seen coming out of the recession. So I think it's a very positive sign. I think when we saw Ben Bernanke back in May of 2013 start to announce the taper tantrum, the taper talks, I think that we did see the initial reaction to that. Again, that's part of that irrational behavior that the market perceives that really doesn't exist. Will there be a pullback in March if rates increase? Maybe moderately. We're seeing, especially in the net lease REITs. These are the REITs that have long-term contractual leases that look more like bonds. But overall, I think most of this action's already been priced in. So I think the rate increases are really going to be positive for real estate. Yeah,
and if we're seeing the economy grow, like the stock market at least is indicating it will, that will be helpful as well and kind of outweigh some of those interest rate increases.
Absolutely, and as long as we don't have a huge interest rate spike, which nobody's anticipating, I think everything's going to be fine, and these dividends will keep moving forward.
Okay, so let's talk specifics a little bit. Do you see anything regionally that is particularly interesting, or in particular sectors of real estate that you're watching? Sure.
Well, as a value investor, I like to look for mispricing. And so some of those sectors that I feel like have the most value today, in other words, they're trading at the cheapest multiples or cheapest prices, would be healthcare, would be one example. We've seen a lot of that space, especially in the skilled nursing space, which is under so much influence due to government regulation. Again, I think part of this with the Trump administration coming in, and now that he's got Tom Price, who's going to be running that area of the government, I think we're going to see reduced regulation, which is going to be a catalyst to drive shares of some of the skilled nursing REITs that have really been beaten up over the last year or so.
Do you have any ticker symbols for those or any names?
Yeah, I mean, two of the pure play skilled nursing REITs are Omega Health Care Investors, that's ticker OHI, very popular REIT, especially for the retail investor. They pay, actually they've paid quarterly dividend increases of 1% over the last 17 or 18 quarters, so very predictable dividend growth. The other one is Care Capital Properties Trust, which is the spinoff of Ventas. Care Capital is CCP, and they are also a pure play skilled nursing REIT. Again, they've been beaten up, so you're talking about 7 to 8% yields, but the dividends are well covered by their earnings, earnings or AFFO. And so I think we've got to, those two companies, again, that's part of that mispricing. Another sector that I like a lot, which is more volatile, is the lodging space. We're seeing a little bit of a rebound here since Trump was in office, but again, that's a volatile space. It's day-to-day rent versus, the healthcare is 5 to 10 year leases. But those hotel REITs or lodging REITs can adapt to interest rate increases literally overnight. Rates go up and down here in New York City. One day you don't know what you're going to get, and so you've got that pricing model built in for that interest rate increase. So I really think those companies. Chatham Lodging is one of the safest ones I like.
And what's the ticker symbol for that?
CLDT.
Okay.
They're based down in Florida. They own primarily limited service hotels, so this is Hampton Inn type product. They own across the country. Primarily they're in coastal markets, which is much stronger for them. What I like about the that particular sector is limited service sector is that if we get to a point and we go into a recession or perhaps the economy tightens up a little bit in terms of consumer demand, I think you're going to see that sector perform better because you're dealing with more transient people. These are the business travelers. They're looking to cut costs. That limited service branding is really perfectly aligned for them when we see that downturn in the economy. But again, I think right now, the lodging space is certainly, we're seeing some high dividend yields. Again, that mispricing. But again, I'll warn investors, it is a more volatile sector than some of the others.
And I want to ask you about malls. They have been under a lot of pressure. Do you see any potential there? Are they undervalued, or is this a long-term trend we're seeing?
Sure. Well, you absolutely. The media has certainly played out these headlines, the risk that the malls are dead. But the malls are absolutely not dead. But what you've got to be in this space is more tactical. You can't just buy a mall REIT. You have to buy a more strategic mall REIT. And what I mean by that, those are the mall REITs that have higher quality, higher productivity, more traffic in their parking lots. So these are companies that we call Class A. They're the highest, the best in class malls. So those REITs would be Simon Property Group, which is ticker SPG. They're one of the largest REITs in the U.S., about an $80 billion market cap. Most all the ETFs own them based on market cap weighting. And we see some value there. They're trading at that discount, again, based on the market and how the market has reacted due to the Amazon effect. The other one I like is Tallman Centers, ticker TCO. They're a little smaller in size, but they also own very high quality malls. I was in Orlando last week at the Money Show, and I went into the Millennium Mall, which is one of the mall properties there. Just unbelievable. No vacancies. I couldn't find a parking spot. If people think malls are dead, just go into one of those properties and you'll see there's life in these properties.
Wow, interesting. Okay, thank you so much, Brad, for sharing all your thoughts and research with us. We appreciate it. Very interesting subject. And thank you as well for joining us on Seeking Alpha Interviews.